When the trumpets of prosperity sound loudest and politicians promise an unending vista of economic expansion, a discerning few have already secured their retreat. These financial clairvoyants possess the rare ability to perceive the fissure before it becomes a chasm, to detect the faintest scent of smoke long before the inferno consumes the marketplace. In the critical, final moments preceding a monumental collapse, they execute their strategy with cold, clinical precision, while the vast majority remain oblivious, lulled by the false alarm of enduring riches. The pivotal days of October 28th and 29th, 1929, provided the most devastating affirmation of this timeless truth. While millions across the American landscape clung to the ephemeral vision of perpetual affluence, the true architects of financial destiny were maneuvering. Their actions would not only define the coming decade of despair, but would solidify fortunes for generations. The essential inquiry is not whether the collapse was inevitable, history confirms it was, but rather, what specific intelligence the ultimate insiders held, at what critical juncture they acquired it, and, most importantly, the surgical actions they took to capitalize on the unfolding catastrophe. As the retail investor base continued to chase the receding mirage of easy wealth, America was thoroughly intoxicated by the decade known as the Roaring Twenties. Share values had ascended rapidly, doubling, then tripling, fueled by astronomical gains in burgeoning sectors like radio, automotive manufacturing, and mass consumer goods. The speculative frenzy was so pervasive that ordinary citizens, many of whom had never possessed a stock certificate, were leveraging their future earnings, plunging borrowed capital into the market. Taxi drivers dispensed complex stock recommendations, and shoeshine vendors debated subtle fluctuations in market indices. The collective delusion held that this epoch of endless ascent was a permanent state of being, yet, underneath this widespread euphoria, a minuscule fraternity of veteran financiers was observing an entirely different constellation of indicators. Joseph Kennedy, the formidable progenitor of a future American political dynasty, began methodically positioning himself for the impending cataclysm many months before its formal arrival. As the general populace celebrated unprecedented market peaks, Kennedy had already initiated a quiet, systematic liquidation of his extensive holdings throughout 1929. The legendary, though likely embroidered, tale suggests his final impetus came when his shoeshine boy offered him trading advice. The reality was a deeper, more calculated understanding of systemic fragility. Kennedy recognized the catastrophic nature of financial leverage. He understood that when the market is universally underpinned by borrowed capital, a precarious mechanism known as buying on margin, the system is rendered a sprawling house of cards. A single severe downdraft, and the entire edifice must disintegrate. By the closing days of October, Kennedy had not merely exited, he had aggressively adopted short positions, wagering against the market's very survival. Bernard Baruch, the celebrated financier whose counsel had guided multiple presidents and who had profited immensely during previous financial tempests, likewise commenced reducing his market exposure in the summer of 1929. Baruch had weathered the savage panic of 1907. He possessed an inherent, almost visceral awareness of the precise moment. Speculation transcends healthy investment and morphs into a destructive mania. When borrowing reaches a fever pitch, when cash is exchanged for ephemeral promises, and when universal belief dictates that prices cannot decline, that exact moment signals the precipice of a severe fall. Baruch later documented that he could discern the danger simply by monitoring the atmosphere on Wall Street, the brash conversations, the unwavering self-assurance, the reckless abandonment of prudence. This climate echoed the pre-collapse environments he had previously navigated. Consequently, by October, Baruch had converted the vast majority of his portfolio into liquid assets and U.S. government securities, fully fortified for the inevitable squall. The apprehension was not limited to individual titans. The Federal Reserve, acting as the nation's central bank, had been subtly but persistently contracting the availability of credit throughout 1,929 inches, an attempt to restrain what officials correctly identified as hazardous speculation. Interest rates, having begun the year at 5%, were progressively escalated to 6% for those attuned to monetary policy. The signal was unambiguous. The era of easy money was drawing to a close when central banking authorities cease inflating a speculative bubble. Its collapse becomes merely a matter of time. Tragically, most investors were too intoxicated by their paper gains to notice the monetary taps being shut off. Furthermore, capital from Europe began an organized exodus from American exchanges weeks prior to the culminating event. Foreign investors, particularly British banking houses, had watched American valuations swell to levels that defied any semblance of fundamental justification. They operated on the firm historical principle that any ascent beyond reason must culminate in an equally violent descent. Quietly, and with characteristic discretion, British financial entities liquidated their extensive American holdings throughout September and early October. When the Black Tuesday arrived, their capital was securely sequestered across the Atlantic. This move was amplified by the actions of the Bank of England, which had increased its own lending rate several times in 1929, primarily to attract gold back to London, an act that starved the already thirsty American credit markets and served as a powerful, yet overlooked, international catalyst for the domestic collapse. The critical warning signs were abundantly evident to those skilled enough to decipher them. Margin calls, the demands from brokers for additional collateral when leveraged stock positions declined, had surged weeks earlier. In leveraged markets, a forced sale triggers a downward spiral, compelling a broker to sell an investor's shares, which further depresses the price, initiating more margin calls. As early as mid-October, brokerage houses were swamped by these demands. The smart money recognized this as a dire premonition. If investors were already struggling to cover their debt during nominal good times, the consequences of a genuine downturn would be catastrophic. Trading volumes had also reached historic, unprecedented peaks throughout October. Superficial analysis interpreted this as overwhelming market enthusiasm. The deeper, more accurate interpretation, grasped by seasoned professionals like Baruch, was that it represented frenetic distribution. Baruch noticed specifically that the physical speed of the ticker tape had fallen hours behind actual transactions, a palpable sign that the volume and the underlying panic of institutional selling was becoming unsustainable. Large, knowing players were systematically offloading their substantial portfolios onto small, unsuspecting amateur investors who still believe the fantasy. This dynamic is the immutable hallmark of every major market bubble. Insiders liquidate, while outsiders commit their final reserves. October 1929 was merely history, repeating its brutal lesson. Even the corporations themselves were flashing distress signals. Throughout the year, corporate executives and insiders have been liquidating their personal stock holdings at record pace. When the very individuals entrusted to manage a business begin dumping their shares, it is a definitive indication that they possess proprietary knowledge the public does not, namely, that the future profitability cannot possibly justify the current valuation. These were not random or isolated sales, they were methodical, stratégique liquidation. The smart money within the boardrooms was heading for the nearest exit, mirroring the actions of the smart money outside. Jesse Livermore, potentially the most formidable speculator of the entire era, had been tactically positioning for disaster since early 1929. Livermore's genius lay in his profound understanding of human mob psychology. He had amassed fortunes during prior panics by aggressively counter-betting the consensus. As 1929 progressed, Livermore meticulously constructed colossal short positions. He wasn't just attempting to sidestep the crash. He intended to profit handsomely from its fury. Every descending tick in stock prices meant magnificent compensation for his bearish wagers. By late October, Livermore was completely prepared for the professional triumph of a lifetime. Crucially, Livermore often masked the scale of his massive short selling using multiple distinct brokerage accounts, a tactic sometimes referred to as conducting bear raids, to prevent the market from realizing the depth of institutional skepticism, ensuring maximum profit when the collapse became universal. The usually placid bond market had been issuing ominous warnings for many months. Ordinarily, when equity prices ascend vertically, bond prices tend to soften as investors abandon secure assets for riskier growth opportunities. However, in late 1929, bonds began a noticeable strengthening trajectory, even as the stock market continued its heady climb. This confusing divergence revealed a profound shift. Sophisticated capital was quietly transitioning from highly speculative equities back into the protective embrace of sovereign debt, preemptively preparing for instability even while headlines celebrated unending prosperity. International monetary flows also hinted at the brewing turmoil. The American dollar had dominated the 1,920 seconds, drawing capital into U.S. markets, but by the autumn of 1929, subtle perturbations indicated a crisis of international confidence. European central banks began aggressively accumulating physical gold rather than holding dollar reserves. It was a silent, powerful international vote of no confidence in the perceived stability of American finance. When the custodians of global reserves lose faith, private capital invariably follows. Perhaps the most catastrophic warning lay within the dangerously unstable architecture of the market itself. By 1929, an estimated 40% of all stock purchases were conducted using margin debt. The market stability was further compromised by the era of specialized vehicle, the investment trust, the precursor to modern mutual funds. These trusts were engaged in relentless leveraging, borrowing money to acquire shares in times, other times investment trusts, which themselves were also highly leveraged. A highly speculative, closed-end fund, such as the infamous Goldman Sachs Trading Corporation, epitomized this perilous practice, borrowing heavily and engaging in activities to prop up its own valuation, creating a pyramid of debt built upon layers of highly inflated, non-productive assets. The professionals understood that when all participants are indebted and prices inevitably begin to recede, the ensuing forced liquidation becomes a self-reinforcing, unstoppable cascade. They had witnessed this immutable pattern in prior financial episodes. Financial gravity always reasserts its dominion. What ascends without corresponding intrinsic value must eventually return to earth. The only remaining variable was the precise moment of impact. By late October 1929, the timing was surgically clear. The smart money was not merely escaping. It was strategically positioned to reap enormous dividends from the structural demolition they knew was imminent. While contemporary newspapers continued to herald a brave new era of permanent prosperity, the financial elite were occupied with radically different calculations. They respected the cyclical nature of markets, the certainty that bubbles must always deflate, and the ruthless demand that leverage always exacts its payment. They had memorized history, and history was about to repeat itself with excruciating, devastating fidelity. The crash, for them, was never a shocking event. It was the inevitable, long-anticipated conclusion for which they had been preparing for over a year. The hours immediately preceding the final collapse were characterized by a storm of urgent telecommunications, secret strategy meetings, and desperate maneuvers to salvage residual value. But for those who had been diligently observing the indicators, October 28th was not a day for panic, it was a day for absolute execution. They activated strategies honed over months, implementing them with surgical resolve. On the morning of October 28th, trading commenced under intense, persistent selling pressure. Although the Dow Jones Industrial Average had experienced significant drops the preceding week, most investors remained convinced it was merely a temporary correction within an unstoppable secular bull market. The smart money, however, possessed superior insight. They instantly recognized this as the initial momentum of the avalanche they had been anticipating. While amateur investors froze in place, clinging to the vain hope of recovery, the professionals aggressively accelerated their exit protocols. Jesse Livermore, in particular, was hyperactive during these critical hours. Having spent months building his short positions, he dramatically increased his wagers against the market on the 28th. Livermore inherently understood that once panic selling takes root, it assumes its own destructive, self-sustaining velocity. Margin calls compel immediate sales to raise liquidity. Those forced sales decrease prices further, triggering a greater wave of margin calls, establishing a ruinous cyclical feedback loop. Livermore perfectly positioned himself to profit from every stage of this downward spiral. The private telephone lines connecting Wall Street to the magnificent estates of Long Island were overloaded with activity. Wealthy, established families who had accrued their fortunes in previous decades were liquidating long-held positions. These transactions were not minor speculative plays. They were profound, generational acts of wealth preservation. The old money class grasped a fundamental truth forgotten by the newer speculators. Markets possess the capacity to erase decades of accumulation in a few short trading sessions. It was infinitely safer to liquidate prematurely than to hold for one moment too long. European capital finalized its retreat on the 28th. British and German banks holding residual American securities dumped them indiscriminately. They had observed the American bubble inflating beyond all rational bounds and demanded no part in its inevitable implosion. The transatlantic cables relayed a continuous stream of sell orders originating in London, Paris, and Berlin. Foreign assets fled America with the maximum speed the 1,929 communications technology permitted. Corporate executives faced their own stark moment of truth. Many held substantial fortunes tied up in stock options. This paper wealth was only convertible if exercised and sold before the crash annihilated their value. Throughout October 28th, company insiders converted their theoretical wealth into hard cash at a feverish pace. As stewards of their own enterprises, they possessed a perspective on the economic horizon that eluded the general public. Clearly seeing the menacing convergence of storm clouds, even the Federal Reserve was in motion. Though their actions remained muted and tentative, central bank officials had convened emergency sessions throughout October, debating the appropriate response. Some argued for a rate reduction to stabilize the market. Others insisted the systemic rot of speculation must be forcefully purged, regardless of the immediate economic pain. While the bureaucratic debate unfolded, the smart money enacted its own decisive measures. Bernard Baruch utilized October 28th to conduct an exhaustive round of consultations across his vast network of financial contacts. Baruch had mastered the art of survival by maintaining a robust internal flow of critical intelligence. These conversations confirmed his gravest suspicions. The overwhelming selling pressure originated not from scared small investors, but from powerful institutions, major banks, and sophisticated individuals who had collectively decided the economic party was conclusively finished. When the largest actors move in perfect coordination, any resistance is futile. Commodity exchanges were also signaling severe distress. which the smart money carefully noted, gold prices had experienced a steady, noticeable ascent throughout October, indicating a widespread flight to safety. Oil futures weakened significantly as traders anticipated a sharp reduction in global industrial demand. Agricultural staples were also under strain as farmers worried about the future availability of credit necessary for planting. These often overlooked movements in commodity markets typically precede equity crashes by several days or weeks, offering confirmation that the stock market event was symptomatic of a broader economic deterioration. Investment trusts, the highly leveraged mutual funds of the era, faced a profound crisis of viability. Having borrowed extensively to amplify their returns during the ascent, they were now receiving devastating margin calls. The trust managers faced a dire choice: either sell their most valuable underlying holdings to generate liquidity, or risk defaulting on their massive loans and facing complete dissolution. Either path would guarantee an acceleration of the market's decline. The smart money recognized this dynamic and positioned themselves to profit from the inevitable forced institutional selling that would result from these impossible administrative choices. Banking stocks were among the earliest and most severely affected sectors on October 28. Professional investors knew that commercial banks were deeply exposed to stock-secured loans. If the market plummeted, numerous banks faced devastating losses from non-performing loans. The initial sell-off in banking equities was highly informed speculation by those who grasped the dangerous interconnectedness of the financial system during times of extreme stress. Despite the obvious signs of liquidation, voices still preached calm. Newspaper editorials pleaded for patience. Government officials spoke confidently of underlying economic resilience. Corporate chiefs insisted their balance sheets were fundamentally robust. But the smart money disregarded the rhetoric. They focused solely on the cold logic of order flow, the severity of credit contraction, and the mathematical certainty of the market's imminent collapse. The options and futures markets, though rudimentary compared to today, were also issuing clear indications to interpreters. Put options, which generate profit from falling prices, were trading at unusually high volumes. Sophisticated capital was not just selling shares, it was purchasing insurance against subsequent declines, a behavior entirely inconsistent with an expectation of a swift rebound. As the day waned, the selling intensified. What began as an orderly liquidation by professionals swiftly catalyzed into outright panic among smaller participants. Margin calls overwhelmed the infrastructure of brokerage houses. Investors who had bought on borrowed money were being forced to sell at the absolute worst possible moment. The smart money observed this forced capitulation with dispassionate calculation. They knew that mass panic creates once-in-a-generation opportunities for those who retain both liquidity and courage. The climactic hours of October 28th meticulously prepared the stage for the annihilating collapse that would define Black Tuesday. For those prepared, the crash was not a tragedy. It was the culmination of a meticulously planned harvest. Throughout the night of October 28th, in the wealthy retreats of Newport in the Hamptons, private secretaries and dedicated brokers worked relentlessly, coordinating the execution of complex, multi-layered transactions designed to preserve and amplify fortunes while millions slept. These were not reactive, panicked decisions. They were the precise, pre-programmed implementation of strategies years in the making. Old wealth understood that preservation required decisive action times before times the public acknowledged the danger. Joseph Kennedy's team remained particularly active. His strategy went far beyond simple divestiture. He simultaneously finalized the liquidation of remaining long positions while establishing colossal short bets across diverse industrial sectors. Kennedy knew the collapse would be uneven. Some industries would be vaporized, others merely wounded. His maneuvers were surgical, targeting the most fragile elements of the indebted economy while avoiding those few businesses with sufficient reserves to weather the coming storm. The secluded dining chambers of Manhattan's elite clubs were filled with hushed, intense conversations throughout the long night. These were emergency strategy summits where the financial aristocracy shared crucial intelligence, identifying the banks most exposed, the corporations carrying toxic debt loads, and the sectors guaranteed to suffer the most profound damage. This was an exchange of critical, timely information, effectively insider trading in its purest form, yet perfectly permissible under the lax regulatory framework of the era. Jesse Livermore commanded his private office, linked to the market by an array of dedicated telephone and telegraph lines. He had dedicated the preceding months to dissecting the exact mechanical rhythm of previous panics. He understood that the truly immense wealth would be generated not just by predicting the crash, but by mastering its cadence. The initial institutional sell-off to establish better short prices, the panic phase for maximum profit extraction, and the final despairing capitulation that would signal the moment to cover his shorts and begin preparing for the subsequent recovery. The transatlantic cables conveyed an unprecedented rush of financial communiques. British capital was not merely selling, it was actively positioning to exploit the American devastation. The Bank of England had quietly hoarded gold for months, anticipating the flight to safety that would enhance the value of sterling at the dollar's expense. British merchant banks were setting up credit facilities, preparing to acquire American assets at rock-bottom fire sale prices. Once the panic reached its inevitable peak, foreign exchange markets betrayed a growing, palpable tension beneath the surface calm. By the pre-dawn hours of October 29th, the international faith in the U.S. financial system was visibly cracking. Swiss institutions converted dollar holdings into gold, French investors shifted assets into rock-solid government bonds, and even Canadian banks significantly reduced their credit exposure to American institutions. The sophisticated investor recognized that subtle shifts in currency valuations often serve as a prelude preceding the stock market's collapse by critical hours or days. As October 29th loomed, corporate boardrooms across the nation became emergency war rooms. Executives who had ridden the wave of soaring stock prices now faced the existential dread of total collapse. Some attempted disparity, symbolic measures to support their company's share price. Others focused exclusively on discreetly liquidating their private wealth before the destruction reached its final stage. The most prescient executives prioritized personal survival, having witnessed how previous crashes had annihilated both companies and careers. The options market, though rudimentary, revealed extraordinary activity in the early morning of Black Tuesday. Affluent investors were not just acquiring put options for profit. They were strategically selling call times options to generate additional premium income from positions they fully intended to liquidate anyway. This level of sophisticated, multi-layered portfolio management demanded both capital and expertise unavailable to the general public. The professionals were systematically extracting maximum residual value from every angle of the accelerating collapse. Banking executives faced their moment of reckoning. Many institutions were severely exposed by massive loans collateralized by stock portfolios, now worth a fraction of the borrowed amounts. Some bankers initiated quiet calls for repayment from their most creditworthy clients, attempting to trim exposure before the full panic materialized. Others established robust lines of credit with correspondent banks, bracing for the inevitable liquidity crunch. The smart money within the financial institutions did not wait for regulatory intervention. They launched their own internal survival strategies. Commodity exchanges continued to confirm the scope of the coming economic earthquake. Gold futures ascended sharply. Silver tracked higher, albeit with greater volatility. Oil futures continued their decline. This movement provided incontrovertible evidence to savvy investors that the stock market was merely the epicenter of a much wider, profound economic contraction. Investment trust managers entered October 29th in an impossible vice. Their borrowing-fueled leverage was now forcing them to liquidate their best assets, the very ones needed for long-term viability to satisfy margin calls. The professionals positioned themselves to exploit this desperate Forced institutional selling targeting entire vulnerable sectors, real estate holdings, luxury goods manufacturers, and consumer discretionary stocks were singled out by sophisticated short sellers who understood that in any economic crisis, non-essential spending is the first casualty. Companies that had thrived during the high-spending boom years would face the most savage punishment during the bust. The Federal Reserve implemented subtle, measured interventions. Certain regional Fed banks cautiously tightened lending standards to member banks, attempting to limit speculation without triggering mass panic. Others prepared contingency plans to supply emergency loans to stem potential bank runs. The central bank walked a treacherous tightrope, fearful of exacerbating the crisis through excessive or premature action. Insurance companies, massive institutional investors holding vast equity portfolios to back policy obligations, made quiet adjustments throughout the night. Their executives recognized that a collapse would trigger regulatory demands to significantly reduce their risk exposure. They proactively sold volatile equities and purchased high-grade government bonds, establishing hedges to protect their enormous capital reserves. The movements of this industry were profoundly significant, as they represented the movements of the era's largest institutional players. Private banking relationships faced the ultimate stress test. Wealthy families moved assets away from institutions they perceived as too fragile, placing them with banks they believed possessed the necessary management and capital structure to endure the coming chaos. These were more than financial transactions. They were essential votes of confidence in institutional survival. The smart money was not simply protecting their net worth. They were aligning themselves with the institutions most likely to emerge, dominant from the inevitable restructuring. The market's collective psychology shifted in ways only the most experienced professionals could identify. Order flow, the widening of bid-ask spreads, and trading volume dynamics all confirmed that institutional selling was reaching a climax. Small investors, paralyzed by hope, still held fast. But the largest pools of capital were moving with frantic urgency. The professionals could perceive that the final tipping point where selling became relentless and prices collapsed under their own dead weight was seconds away. As the sun rose on Black Tuesday, October 29th, the stage was perfectly set for one of the most catastrophic financial events in recorded history. For the prepared, the crash was not a disaster. It was the realization of a colossal opportunity. They had spent months in preparation, and they were now about to be rewarded for their foresight with monumental profits such as Jesse Livermore's legendary haul, estimated to be nearly $100 million in $1929 fortunes that would endure for generations, while the savings and dreams of millions of ordinary Americans were utterly annihilated. The morning of October 29th unleashed a torrent of chaos that the smart money had meticulously prepared for. While the amateur investor base still clung to optimism, the professionals executed the final, devastating phase of their strategies. The opening bell signaled immediate and overwhelming selling pressure, a spectacle Wall Street had never witnessed. This was not the random effect of mass panic. It was the controlled demolition engineered by those who fundamentally understood how complex financial systems implode when pushed beyond their breaking limits. Jesse Livermore was intensely engaged in these pivotal opening minutes, dramatically increasing his already massive short positions as prices collapsed lower. He understood that the enduring profits in market crashes originate not in the initial decline, but in the frenetic acceleration phase, when systemic force selling generates its own ruthless momentum. Livermore, having analyzed every major panic since the 1,870 seconds, recognized the mathematical certainty of the unfolding event. When debt is liquidated in a falling market, selling inevitably breeds further selling until the entire leverage structure is extinguished. The public communication infrastructure connecting Wall Street to the nation was paralyzed within the first hour of trading. However, the smart money did not depend on public lines. They utilized private dedicated telegraph connections, proprietary phone lines, and swift messenger services, ensuring they could execute their trades flawlessly, while ordinary investors waited helplessly for their broker's line to connect. This infrastructural advantage was highly deliberate, built specifically for such moments of systemic breakdown. The crash of 1929 was, for those who truly mattered, never an unforeseen event. It represented a monumental, calculated transfer of wealth from the trusting multitude to the highly disciplined few who were prepared, while millions watched their life savings vaporize in mere days. The smart money counted profits that would compound exponentially for decades. The lesson remains brutally clear, yet timelessly valid. Markets reward relentless preparation, never blend hope. They favor those who rigorously interpret signals over those who merely subscribe to pleasant narratives, and they will always savagely punish the crowd, simultaneously enriching those bold and prescient enough to wager against the prevailing delusion. History does not repeat itself exactly, but if one ignores its core structural patterns, the outcome is guaranteed to be devastating.